Perhaps the banking industry's overall situation is even worse than we anticipated. It's because, following the recent failure of 3 national banks and the subsequent Federal Reserve bailout, another domino may soon fall, but this time it may be different. Credit Suisse is one of the world's largest financial institutions. After all, things are getting so bad that their stock price dropped from $9 to $2 in a single day. The company's largest backers recently declined an appeal for additional funding. Some believe the bank contagion has only just begun, heralding the start of a long-term crisis. Given these assertions, as well as the interconnected nature of the banking system as a whole, it is critical to dissect the current situation and assess the implications for the market, as well as the likelihood of additional bank failures in the near future. Then consider what steps you might take to protect your interests in the future. However, before we begin, please subscribe if you want to stay up to date on all market developments. A fundamental understanding of how banks work is thus required to fully appreciate the gravity of the current situation. And in order to do so, I must introduce you to Credit Suisse. They are among the top global banks, with over $1.5 trillion in assets. The company employs over 50,000 people and operates in over 100 countries. Adding a label as one of the systemically important financial institutions in 2023, they have a significant impact on a wide range of monetary transactions. This is why they are regarded as one of our economy's too big to fail pillars. A look back at their history, on the other hand, paints a somewhat different picture. Credit Suisse, for example, was fined $5.3 billion in 2017 for its role in the mortgage-backed securities crisis of the 2000s. A major financial crisis that, according to one statistic, resulted in the loss of billions of dollars in wealth and had a significant negative impact on the lives of ordinary Americans. The bank was aware that the investments it was selling contained loans that were highly likely to default, but it continued to do so despite this knowledge, as revealed in the settlement announcement. However, that was only the tip of the iceberg. They lost $536 million in 2009. They admitted guilt in 2014 for assisting U.S. taxpayers and filing a false return. This time, the fine is $2.5 billion. In 2019, they were caught spying on their own top executives, forcing their CEO to resign. Their client list, which included people who would almost certainly have had this video demonetized if they were found guilty of money laundering, cost them $4.7 billion in 2021 after the failed investment firm that had defrauded their clients in 2020 leaked their client list. They also paid a $500 million mortgage fine just before the end of the year. However, given recent events, it's easy to see why some predict an even more disastrous collapse in the near future. I'll tell you everything you need to know. All of this begins near the end of 2022, when Credit Suisse's CEO issued a statement cautioning employees not to confuse the bank's volatile stock price with its strong capital base and liquidity position. When and why would they say something like that? Perhaps you're curious. But that wasn't all. They were about to embark on a major risk restructuring in an effort to return the company to profitability after its stock price had fallen by more than 90% over the previous decade. However, they encountered difficulties in obtaining funding for this, and some saw it as a last resort. Similar to what Lehman Brothers was doing prior to their infamous failure. Banks must pass a stress test to ensure that they can continue to operate in the face of a wide range of economic scenarios. Not to mention their previous failure rates. Because their Tier 2 capital has not kept up with regulatory requirements, the bank lacks the net capital required to successfully restructure, according to Yahoo. And chaos ensued not long after that. After more people investigated the company's finances, critics warned of the company's future direction, declining revenue, and diminishing returns, claiming that it could have a significant impact on the entire market, which only worsened through 2022. Credit Suisse's largest annual loss since the 2008 financial crisis was caused in large part by billions of dollars in customer withdrawals. Due to their global connections, Credit Suisse were vulnerable to global market shock and counterparty default in the Federal Reserve's stress test in February 2023. Finally, as if things weren't bad enough. On March 14, the financial institution reported that effective internal controls had revealed significant issues with its financial reporting over the previous 2 years. Possible examples include material misstatements and insufficient account balances for disclosures. And when one of the world's largest banks says something like this, their customers have every right to be concerned, as evidenced by the credit default swaps market. I know it sounds complicated, but consider this. Whenever a bank extends credit to a borrower, the bank has the option to purchase a credit default swap, which acts as insurance if the borrower fails to make loan repayments. In this scenario, one bank can pay another bank a small fee to buy out their risk, and the second bank will then assume all of the risk. The second bank has no recourse if the first bank demands repayment because it has assumed the rights to the underlying investment and is collecting enough premium from other credit default swaps to offset the risk. However, if a bank issues too many credit default swaps and does not have enough money to cover all of the insurance claims, the bank may have to raise a large sum of money to make up the difference. Furthermore, if they do not lose weight, they may fail. This is reminiscent of the great financial crisis of 2008, when banks such as Lehman Brothers failed due to a lack of capital after failing to settle non-performing loans. There is a growing fear that the past is repeating itself, albeit with a new twist. Credit Suisse is a major buyer of residential mortgages in the United States. In recent months, a record number of customers have begun making cash withdrawals. As of today, the price of their credit default swaps has reached an all-time high, indicating that some investors are betting on the company's total failure. Everything that is happening right now is a direct result of the failure of a Silicon Valley bank, which prompted widespread regulatory scrutiny of the banking industry and brought Credit Suisse back into the spotlight. The co-head of banking abruptly left the company last year, only 9 months into his new position, after 27 years with the company. Furthermore, they've repeatedly been on the wrong side of bad trades, the most recent of which left them $6.5 billion in debt. As a result, despite a $800 million lawsuit and other potential issues, they have reduced their overall operations by laying off 9,000 workers. It's approaching the point where they must make a major decision soon, and things aren't looking good. To put it another way, people were withdrawing money from a bank that was already losing a lot of money, which exasperated and may continue to exasperate liquidity risks. Furthermore, their largest investor, the Saudi National Bank, stated that they would not provide additional capital or promote them within the bank. They believe that the correct answer is no, and for good reason. I'll start with the legal and regulatory requirements. We have a 9.8% chance of not knowing the bank. We will be subject to new regulations from both our domestic agency and the European and Swiss governments if we exceed 10%. What are the chances that this particular institution would fail in the event of a bank failure? It's possible that a fairly devout the general state of affairs. All of this is, to some extent, familiar. When Lehman Brothers failed in 2008 due to excessive mortgage leverage, the entire market suffered losses, and 26,000 people lost their jobs. Investors were concerned about the future of their own portfolios. Following the bankruptcy filing of Lehman Brothers, over 75 additional cases of financial distress were documented. As a result, more than one business suffered negative consequences, leaving out the possibility that people will lose faith in banks. Some are concerned that if more people withdraw their money, bank runs, liquidity issues, and further consolidation among banks that people believe are too big to fail will worsen. If Credit Suisse were to suddenly cease operations, it would likely have a significant impact on the economy. This label was created in 2010 in order to increase regulation of the country's largest banks. To answer your question about whether you should be concerned, the government is taking this step to ensure that these businesses act responsibly, which, given everything they've done, is laughable. The correct answer is that it is feasible. With such a large customer base, I believe it is highly unlikely that they will go bankrupt in a single day if Credit Suisse experiences financial difficulties. Even though the Swiss National Bank believes the bank is adequately capitalized, it has promised to backstop any losses until the bank can hopefully become profitable again. All of this was done in the hope that consumer trust in the system would prevent a sudden exodus of funds from the market, thereby calming the markets. As a result, despite what the news may suggest, I don't believe there is a real threat in the markets, though it is still a good idea for customers to diversify their portfolios. Credit Suisse, on the other hand, is large enough that the government may be forced to bail it out if it fails and causes widespread economic distress. Larry Fink, CEO of BlackRock, disagrees, claiming that the financial world is simply witnessing the inevitable result of years of easy money. You also have an idea of who he could be, right? For example, The 1980s savings and loan crisis lasted nearly a decade and resulted in the total failure of thousands of financial institutions. However, in this case, I believe a more realistic approach would be for Credit Suisse to be bailed out, given a slap on the wrist for paying over $11 billion in fines over the last 20 years, and allowed to carry on with business as usual until the next headline. This is not to say that there is no danger. However, previous bailouts indicate that they will be halted again, at least temporarily. In light of this, I believe it is critical to diversify your investments, never exceed your FDIC limit, and recognize that a market panic may present an opportunity to buy low and accumulate wealth over time. You could also look into ChatGPT, which correctly predicted the March 15 market crash.